while central banks quietly accumulated 387 tons in the final quarter, while manufacturing demand outpaced mining supply by 18% for 3 consecutive years, while institutional money moved $4.2 billion into physical positions in January alone, the headlines told the public to watch technology stocks. This wasn't coincidence. Between September 2025 and February 2026, something fundamental shifted in the global monetary architecture, something that hasn't happened since 1971. And the professionals positioning for it aren't buying bonds. They aren't rotating into equities. They're securing control over one specific industrial metal that sits at the intersection of 3 converging crises. And if the pattern holds, what comes next will redefine portfolio construction for the next decade. Welcome to Financial Crisis Explained. Before we proceed with what might be the most critical strategic briefing of this quarter, may I ask a small favor? You know how we used to keep important documents in a safe place where we could find them when needed? That subscribe button below works the same way. It ensures this analysis finds you again when the next phase unfolds. Consider it your financial filing system for uncertain times. And please, drop a comment telling us which city or country you're watching from today. Because what's unfolding in silver markets affects different regions in different ways. And your location context helps us understand how to serve you better in future briefings. Now, let's examine what Wall Street isn't saying. The financial community operates on a peculiar rhythm. While retail investors chase headlines about artificial intelligence stocks and debate Federal Reserve interest rate projections, institutional capital has been executing a different playbook entirely. Between October 2025 and February 2026, a quiet repositioning occurred in commodity markets that received almost no mainstream coverage. Yet the volume, velocity, and strategic nature of these movements suggest something far more significant than routine portfolio rebalancing. Silver closed January 2026 at price levels that caught most analysts off guard, not because of dramatic single-day movements, but because of persistent, methodical accumulation that defied traditional seasonal patterns. The metal that industrial manufacturers require for solar panels, electric vehicle components, and advanced electronics, the same metal that sovereign wealth funds have begun stockpiling, moved upward on unusually thin available supply. Trading desks reported something they hadn't seen in years: difficulty sourcing physical metal in size, even at elevated premiums. This presents an immediate analytical puzzle. Silver mining production hasn't collapsed. No major geopolitical event disrupted primary supply chains. South American mines continue operating. Refineries process ore at normal capacity. Yet the gap between paper price and physical premium widened to levels typically associated with supply emergencies. Someone, or more accurately, multiple institutional someones, decided that owning claims on silver wasn't sufficient anymore. They wanted the metal itself, allocated, segregated, deliverable. The data points supporting this thesis don't come from breathless YouTube personalities or newsletter promoters. They emerge from COMEX warehouse reports showing systematic drawdowns, from mining company earnings calls where CFOs discuss forward sale contract buybacks, from manufacturing industry publications mentioning extended lead times for industrial silver procurement, from central bank disclosure documents filed in jurisdictions that still require such transparency. Individually, these signals might mean little. Collectively, they sketch the outline of a structural shift. What makes this moment distinct from previous silver price rallies is the absence of retail mania. The 2011 surge brought millions of first-time buyers into coin shops, driving premiums to absurd levels as everyday investors chased momentum. The 2020 movement emerged from social media coordination and short squeeze speculation. Both episodes ended predictably when sentiment reversed and leveraged positions unwound. The current environment exhibits none of those characteristics. Retail interest remains muted, social media buzz sits near multi-year lows, yet professional accumulation continues regardless of public attention. This divergence matters enormously for anyone attempting to position capital intelligently. Markets, driven by retail emotion, produce chart patterns that technical analysis can navigate with reasonable success. Markets, driven by institutional strategic repositioning, operate under entirely different mechanics. The latter don't reverse on sentiment shifts. They persist until fundamental supply-demand imbalances resolve, which in commodity markets can require years, not months. The strategic question then becomes, what do sophisticated allocators understand that hasn't yet filtered into public consciousness? 3 possibilities present themselves. First, they may possess superior information about coming industrial demand that public forecasts underestimate. Second, they may interpret monetary policy trajectories differently than consensus, seeing currency debasement risks that bond markets haven't priced. Third, they may simply recognize that physical commodity exposure provides portfolio insurance that financial engineering cannot replicate when systemic stress emerges. Historical precedent offers useful context. The commodities repositioning that began in 2003 took 18 months before financial media noticed. By the time magazine covers featured stories about the commodities supercycle in 2006, the early positioning phase had long since concluded. Patient capital that entered when fundamentals shifted, but sentiment remained skeptical, captured the most significant returns. Those who waited for confirmation from CNBC bought at substantially higher entry points. The professionals moving into silver now aren't making entertainment decisions. They're making balance sheet decisions, fiduciary responsibility decisions, capital preservation decisions. They've run the scenarios. They've stress-tested portfolio allocations. They've examined what happens to paper assets when monetary systems reach mathematical sustainability limits. And their conclusion, expressed through actual capital deployment rather than public commentary, points decisively toward physical metal exposure. What comes next depends entirely on whether supply constraints intensify or resolve, whether industrial demand continues outpacing mining output, whether monetary authorities maintain current policy trajectories or pivot dramatically, whether geopolitical fractures deepen or heal. But the positioning is already underway. The question facing individual decision makers isn't whether institutions are accumulating silver. The evidence confirms they are. The question is whether the thesis driving that accumulation deserves serious consideration in personal portfolio construction. The conversation around silver typically begins and ends with investment demand. Traders debate whether it functions as money or commodity. Analysts compare gold to silver ratios. Speculators watch technical chart patterns. Meanwhile, an entirely separate force has been reshaping the physical market with almost no financial media acknowledgement whatsoever. Manufacturing engineers don't care about ratio analysis. They care about conductivity, reflectivity, malleability, and antimicrobial properties. And their procurement requirements have fundamentally altered over the past 36 months in ways that cannot reverse without dismantling the global energy transition itself. Consider the solar panel manufacturing trajectory. Each photovoltaic panel requires approximately 20 grams of silver for the conductive pathways that transport electricity. That number sounds trivial until one examines installation forecasts. The International Energy Agency projects solar capacity additions exceeding 400 gigawatts annually through 2028. Converting gigawatts to panel units, then panels to silver consumption, produces a staggering figure: over 3,200 metric tons consumed by solar manufacturing alone each year. That represents roughly 13% of total annual mine production, devoted to a single application that barely existed at commercial scale 15 years ago. Electric vehicle architecture presents an even more interesting case study. The average internal combustion engine vehicle contains approximately 15 to 28 grams of silver in various electrical components. The average electric vehicle requires between 25 and 50 grams, with some luxury models exceeding 80 grams per unit. Battery management systems, charging infrastructure, power inverters, and sensor arrays all demand silver's unique electrical properties. With EV production crossing 18 million units in 2025 and manufacturers targeting 40 million units by 2030, the mathematics become uncomfortable for supply planners. This isn't substitutable demand. Copper cannot replicate silver's performance characteristics at the current state of material science. Using gold would solve conductivity requirements while destroying unit economics entirely. Then, the telecommunications infrastructure variable enters the equation. The 5G network build-out that began in 2020 continues accelerating despite economic headwinds in other sectors. Each 5G base station contains significantly more silver than previous generation equipment due to higher frequency requirements and increased component density. China alone deployed over 2 million 5G base stations between 2020 and 2025. Europe and North America lag behind, but have committed infrastructure capital that cannot be unspent. India's telecommunications expansion adds another massive demand center that didn't exist in previous commodity cycles. The silver required for this single application dwarfs what entire industries consumed 2 decades ago. Medical technology represents the demand variable that almost never appears in investment analysis, yet hospital procurement departments understand intimately. Silver's antimicrobial properties make it irreplaceable in wound dressings, surgical instruments, medical implants, and diagnostic equipment. The global medical silver market consumed approximately 100 tons in 2023. Healthcare infrastructure expansion in developing economies, aging demographics in developed nations, and post-pandemic medical capacity investments all drive this figure higher. Unlike industrial applications, where engineers continually seek cheaper alternatives, medical applications prioritize performance and safety over cost optimization. This creates uniquely priced inelastic demand. Now, examine the supply response to these converging industrial requirements. Total global silver mine production in 2024 reached approximately 26,000 metric tons. That number has remained essentially flat since 2016, despite prices rising substantially during that period. Why hasn't higher pricing stimulated increased production as economic theory predicts? The answer reveals uncomfortable truths about modern mining economics. Primary silver mines represent only 30% of global production. The remaining 70% emerges as byproduct from copper, lead, and zinc operations. When those base metal mines reduce output due to their own market dynamics, silver production falls regardless of silver pricing. Miners cannot simply produce more silver in response to demand. The metal comes out of the ground in fixed ratios determined by geology, not market signals. The few primary silver deposits that do exist face timeline realities that make rapid supply expansion impossible. From discovery to production, a new silver mine requires 8 to 12 years under optimal regulatory conditions. Permitting alone can consume half that timeline. Environmental assessments, community consultations, infrastructure development, and capital raising all impose unavoidable delays. A mining company responding today to current price signals won't deliver additional supply until the early 2030s. Meanwhile, solar panel factories opening this quarter require silver deliveries this quarter. Recycling provides some supply relief, but far less than commonly assumed. Silver's industrial use disperses the metal into products where recovery proves economically unviable. Extracting silver from a discarded smartphone costs more than the recovered metal's value. Photography, once a major silver application, has virtually disappeared, eliminating that entire recycling stream. Only jewelry and large format industrial applications produce meaningful recyclable quantities. The Silver Institute estimates total recycling adds roughly 4,800 tons annually. That helps, but it doesn't close a gap measured in thousands of tons. Strategic stockpiling behavior adds another dimension that traditional supply-demand models struggle to incorporate. When governments view materials as national security priorities rather than mere commodities, their purchasing patterns don't follow price sensitivity curves. China's State Reserves Bureau doesn't publish procurement data, but analysis of import-export flows suggests systematic accumulation over multiple years. India recently announced strategic metal reserve initiatives. The European Union designated silver a critical raw material, requiring supply chain diversification. These aren't commercial decisions seeking optimal entry prices. These are sovereignty decisions, accepting current prices as irrelevant compared to future availability. The implication becomes mathematically unavoidable. Industrial demand growing at 8 to 12% annually, while supply grows at 0 to 2%, produces a deficit that compounds year over year. Investment demand hasn't even entered this calculation yet. When the financial community eventually recognizes this industrial reality and allocates even modest percentages towards silver exposure, the available supply becomes insufficient at current pricing levels. Market's clear, physics demands it. The question isn't whether prices adjust. The question is how violently that adjustment occurs and who positions beforehand versus who reacts afterward. The manufacturing engineers already know. Their procurement teams live this reality daily. The financial analysts haven't caught up yet. But they will. They always do, just usually too late. There exists a particular type of silence in financial markets that precedes structural breaks. Not the silence of inactivity, but rather the silence of coordination, and where central banks communicate through actions they hope remain unnoticed, while academics debate theories that matter progressively less. Since August 2023, a pattern has emerged that suggests the global monetary architecture is fragmenting in ways that will force asset revaluation across categories. Silver sits at a unique intersection of this fracture because it maintains dual identity: industrial input and monetary metal. What happens when the world's reserve currency system enters its terminal phase doesn't require apocalyptic scenarios. It merely requires mathematical honesty about debt sustainability and purchasing power preservation. The United States Treasury now carries debt exceeding $36 trillion. The interest expense on that debt surpassed defense spending in fiscal year 2024. This isn't political commentary. This is accounting reality. When debt service becomes the largest budget line item, the government faces exactly 3 options: default explicitly, default through inflation, or restructure obligations. Explicit default remains politically impossible for a reserve currency issuer. Restructuring requires creditor consent that won't materialize voluntarily. That leaves inflation, which politicians can implement without legislation simply by maintaining current policy trajectories. The Federal Reserve cannot raise rates sufficiently to contain inflation without triggering sovereign debt crisis. They cannot lower rates without accelerating currency debasement. This paradox has no technical solution, only political choices about who bears the cost. European central banks face identical mathematics with worse demographics. Japan's debt-to-GDP ratio exceeds 250%, a level that exists nowhere else in peacetime economic history. China's local government financing vehicles carry obligations that dwarf official statistics. Every major currency bloc operates under fiscal constraints that permit exactly one realistic path: steady purchasing power, erosion managed carefully enough to avoid panic, but decisively enough to reduce real debt burdens. This isn't conspiracy theory. This is how sovereign debt crises resolve when default proves politically unacceptable. Yet here's what makes the current moment distinct from previous currency debasement episodes. The 1970s stagflation occurred within a relatively contained financial system where capital controls still functioned and alternative stores of value remained limited. Investors could choose gold, real estate, or perhaps certain commodity exposures, but moving significant capital across borders required navigation of regulatory frameworks designed to trap domestic wealth. Today's environment offers no such constraints. Wealth moves globally in milliseconds. Sophisticated capital can exit any currency at will, forcing central banks into accommodation they would have rejected decades ago. When the European Central Bank attempts tightening, capital flees to dollar assets. When the Federal Reserve raises rates, emerging markets face currency crises. The interconnection creates a race to the bottom where no central bank can maintain sound money policy without triggering financial disruption somewhere in the system. This creates what game theorists call a coordination problem. Every central bank knows currency debasement destroys long-term credibility. Every central bank also knows that maintaining harder money than peers destroys short-term economic competitiveness. The Nash equilibrium of this game produces synchronized debasement, where all players defect from sound money simultaneously. We're watching that equilibrium emerge in real time. The Bank of Japan abandoned yield curve control after defending it for years. The European Central Bank resumed rate cuts despite inflation remaining above target. The Federal Reserve pivoted from higher for longer to rate reduction discussions within quarters. These aren't independent decisions. These are coordinated responses to a system that can no longer sustain positive real interest rates without fracturing. Institutional investors understand this dynamic far better than public commentary suggests. When pension funds shift allocations from bonds to real assets, they're not making tactical trading decisions. They're acknowledging that fixed income instruments denominated in debasing currencies cannot fund future liabilities. When sovereign wealth funds increase commodity exposure, they're hedging against the very currency reserves they're required to hold. When family offices move percentages into physical metals, they're implementing insurance against scenarios their public statements would never acknowledge. The professionals managing serious capital don't need monetary collapse. They merely need continued erosion at rates that compound devastatingly over pension payout horizons. Silver's role in this environment carries unique characteristics that gold alone cannot replicate. Gold functions purely as monetary metal and wealth reserve. Its price reflects entirely on monetary conditions and sentiment toward currency alternatives. Silver maintains that monetary function while simultaneously serving irreplaceable industrial purposes. This dual nature creates asymmetric payoff structures. In scenarios where monetary debasement accelerates but economic activity continues, silver captures both monetary premium and industrial demand growth. In scenarios where economic activity slows but currency concerns intensify, silver maintains monetary support. The only scenario where silver underperforms dramatically requires both sound money policy restoration and industrial demand collapse, a combination that appears increasingly unlikely given political economy constraints. The counterparty risk dimension adds further urgency to physical positioning. During the 2008 financial crisis, investors discovered that paper claims on assets behave very differently than asset ownership when system stress emerges. Exchange-traded funds faced redemption suspensions. Futures markets experienced limit-down days preventing exit. Allocated storage programs revealed terms permitting reallocation under certain conditions. The difference between owning silver and owning a financial instrument that promises silver delivery became painfully apparent. Today's environment features similar risks magnified by increased financial leverage, more complex derivative structures, and less regulatory certainty about crisis intervention protocols. Central banks themselves have become net buyers of gold for the first time in generations, adding over 1,000 tons annually for 3 consecutive years. They're not buying through exchange-traded products. They're taking physical delivery and storing in sovereign vaults. This behavior communicates their private assessment of monetary system stability far more clearly than their public statements about transitory inflation and soft landings. When the institutions that create currency choose to hold metal instead, the signal should require no interpretation. The fragmentation accelerates regardless of whether populations recognize it. Currency blocks are forming along geopolitical lines rather than economic efficiency principles. Trade settlement increasingly bypasses dollar systems, not because alternatives are superior, but because political risk makes dollar dependency dangerous. The architecture established at Bretton Woods in 1944 is dissolving without replacement framework, creating transition period uncertainty that historically drives capital toward tangible assets. Silver won't fix broken monetary systems. No asset can. but it offers characteristics that paper instruments inherently lack: no counterparty risk, finite supply, industrial necessity, and 80 centuries of monetary acceptance. When currencies compete by debasement and financial claims multiply faster than underlying assets, those characteristics matter profoundly. The institutions accumulating physical silver aren't betting on apocalypse. They're implementing prudent hedges against mathematics that no political rhetoric can alter. The system fragments slowly until suddenly it doesn't. Positioning before the sudden part matters considerably more than understanding the slow part. The slow part is already finished. Understanding thesis and executing strategy represent entirely different skill sets. The preceding analysis establishes why silver merits serious consideration within diversified portfolios. This section addresses how thoughtful capital allocation actually occurs, what separates professional positioning from amateur speculation, and which specific risks demand monitoring regardless of conviction level. The difference between recognizing opportunity and capitalizing on it lies entirely in implementation quality. Poor execution of sound thesis produces worse outcomes than avoiding the position entirely. Portfolio context must precede position sizing. Silver does not constitute a complete investment strategy. It functions as one component within a broader framework addressing multiple economic scenarios simultaneously. The appropriate allocation depends entirely on individual financial circumstances, existing asset composition, liquidity requirements, and risk tolerance. A retiree living on fixed income faces different considerations than a young professional accumulating wealth. A family office managing generational capital operates under different constraints than a salaried employee building retirement savings. No universal prescription exists. However, certain principles apply across situations. Conservative positioning suggests silver exposure between 5 and 15% of investable assets. This range provides meaningful participation if the thesis proves correct while limiting damage if contrary scenarios materialize. Aggressive positioning might extend to 25% for those with higher risk tolerance and longer time horizons. Beyond that threshold, concentration risk begins overwhelming diversification benefits, regardless of conviction. The investors who suffered most severely during previous commodity corrections weren't those who owned metals. They were those who owned nothing else. Avoid that mistake, regardless of how compelling the fundamental case appears. Physical versus paper instruments present the next critical decision point. Physical silver means actual metal. Coins, bars, stored in allocated fashion, where specific serial numbers belong to specific owners. Paper silver means financial claims, exchange-traded funds, mining company equities, futures contracts, or certificates promising metal delivery. Each serves different purposes and carries distinct risk profiles. Physical metal provides complete insulation from counterparty risk, but imposes storage costs, insurance requirements, and liquidity friction. Paper instruments offer ease of trading and no storage concerns, but introduce counterparty dependencies that become problematic precisely when they matter most. For core strategic positions intended as long-term monetary insurance, physical metal remains superior despite its inconveniences. The entire purpose of holding hard assets is eliminating dependence on financial system functioning. Defeating that purpose by holding paper proxies makes little sense. However, physical ownership becomes impractical for short-term tactical positions or trading strategies. An investor planning to adjust exposure quarterly based on technical indicators cannot efficiently trade physical metal given transaction costs and timing delays. Paper instruments serve that use case appropriately. The key lies in matching instrument type to intended holding period and strategic purpose. Execution quality in physical markets varies dramatically across dealers. Premium structures, authentication guarantees, and buyback policies differ substantially. Reputable dealers charge transparent premiums that reflect actual market conditions. Disreputable operators exploit information asymmetry to extract excessive spreads. Before executing transactions, verify dealer credentials through industry organizations, check customer reviews across multiple platforms, and compare pricing against spot markets plus reasonable markup. Government mint products like American Silver Eagles or Canadian Maple Leafs carry higher premiums than generic rounds but provide superior liquidity and universal recognition. For smaller positions, the premium difference matters little. For substantial allocations, those percentage points compound significantly. Storage decisions carry implications that extend beyond simple cost comparison. Home storage provides immediate access and eliminates third-party dependency, but introduces security concerns and potential loss scenarios. Bank safe deposit boxes offer reasonable security at modest cost, but become inaccessible during bank holidays or financial emergencies, precisely when access matters most. Private vault services provide professional security and insurance, but reintroduce counterparty risk if vault operator faces business continuity problems. Offshore storage in jurisdictions with strong property rights and political stability adds another layer of diversification, but complicates estate planning and tax reporting. No perfect solution exists. Thoughtful investors typically employ multiple storage methods, accepting trade-offs inherent in each approach. Tax treatment varies substantially across jurisdictions and ownership structures. In the United States, physical silver is classified as collectible under tax code, subjecting gains to higher rates than typical capital assets. Individual retirement accounts can hold certain silver products, but not others, with specific purity and form requirements. Trusts, limited liability companies, and other entities face different rules. International investors navigate entirely separate frameworks. Before executing significant positions, consult qualified tax professionals familiar with precious metals treatment. The difference between tax-efficient and tax-inefficient structuring can consume substantial portions of returns over time. Scenario analysis provides essential framework for managing positions once established. The bull case envisions silver reaching $75 to $100 per ounce, driven by sustained industrial deficit combined with monetary debasement acceleration. This scenario requires no catastrophic events, merely continuation of current industrial demand trends and persistent fiscal irresponsibility from major currency issuers. Historical precedent suggests such moves can occur within 18 to 36 months once momentum establishes. The base case anticipates gradual appreciation to $45 to $60 as supply constraints become increasingly apparent and institutional allocation increases modestly. This represents measured revaluation rather than explosive repricing. The bear case involves technological breakthrough enabling silver substitution in major applications, simultaneous global recession, crushing industrial demand, or unexpected major deposit discovery dramatically expanding supply. Each scenario has probability that rational analysis can estimate. Monitoring triggers determine when thesis reassessment becomes necessary. Specific data points warrant attention regardless of short-term price movement. If solar panel manufacturers announce successful silver reduction technologies reaching commercial scale, the industrial demand thesis weakens materially. If multiple large primary silver deposits receive production permits simultaneously, supply projections require revision. If central banks reverse course toward genuine inflation, fighting with sustained real positive rates, monetary debasement assumptions need updating. If COMEX warehouse inventories surge rather than decline, physical shortage thesis faces challenge. Establish these triggers before position initiation. Emotional attachment to thesis produces catastrophic decision-making when evidence shifts. Risk management protocols must address both position risk and process risk. Position risk involves how much capital is allocated. Process risk involves how decisions get made. The investor who establishes 15% silver allocation based on careful analysis faces position risk calibrated to their situation. The investor who panics into 30% allocation after reading alarming headlines faces both excessive position risk and process risk from emotional decision-making. Conversely, the investor who recognizes compelling thesis but never acts due to perpetual analysis paralysis faces opportunity cost that compounds over time. Effective protocol involves setting allocation range, establishing entry approach, defining monitoring schedule, and determining adjustment triggers in advance. Then execute systematically, regardless of psychological comfort. Dollar cost averaging versus lump sum entry presents final tactical consideration. Academic research generally favors lump sum deployment when thesis conviction exists, as markets trend upward over time. However, commodity markets exhibit volatility that can test conviction severely. An investor committing full allocation at local peak, who then watches 20% decline, may abandon position at exactly wrong moment. Dollar cost averaging, through systematic purchases over 6 to 12 months, reduces that psychological risk while ensuring participation. The mathematical return difference typically matters less than behavioral ability to maintain positions through inevitable drawdowns. Silver's unique position as both industrial necessity and monetary alternative creates opportunity that appears perhaps once per decade. The convergence of supply constraints, demand growth, and monetary system stress rarely align so clearly. But opportunity without execution produces only regret. The institutions positioning now understand this completely. Their capital moves quietly, deliberately, without fanfare or hesitation. Individual investors possess the same information and same opportunity. The difference lies entirely in whether analysis translates into action calibrated appropriately to personal circumstances. The window remains open. Supply-demand imbalances require years to resolve. Monetary fragmentation accelerates slowly, but windows close. They always do, usually after the easy money has already been made. The strategic question facing each decision-maker isn't whether silver deserves consideration. The evidence confirms it does. The strategic question is whether to position before confirmation becomes consensus, or wait until consensus makes positioning considerably more expensive. History suggests one approach works substantially better than the other. Implementation quality determines which investors benefit and which observe from sidelines. The choice, as always, remains entirely individual